Hello and welcome to the Intentional Brief, your weekly video update on the one big thing in cybersecurity news for middle market companies, their investors, and executive teams. I'm your host, Shay Colson, and you can find us online at intentionalcyber.com. Today is Monday, February 23rd, 2026, and I would like to congratulate both the U.S. men and U.S. women's hockey teams on their gold medals at the Olympics. The men's game yesterday was one of the best I have ever seen, and if there is not a dental clinic somewhere in New Jersey rushing to gift a set of brand new gold teeth to Jack Hughes, I think they are missing a truly golden opportunity, pun very much intended. This week we've got the intersection of private equity and cybersecurity front and center thanks to a long piece published last week by Bloomberg. So we're going to jump right in. In this long piece titled, quote, How Private Equity Debt Left a Leading VPN Open to Chinese Hackers, quite a headline, the Bloomberg reporters Jordan Robertson and Paula Seligson detail pretty extensively the trials and tribulations of the VPN tool PulseSecure and by extension their parent company Ivanti based in Salt Lake City. The article details in what appears to be a very well-sourced spread just how the ownership structure of PulseSecure led to a loss of both institutional knowledge on how the product worked and a loss of runway to continue to make security investments that were very much needed. The quotes from the Bloomberg piece don't leave much room for interpretation, including, quote, Private equity firms often prioritize increasing profits and paying down debt over continuous investment in product development, unquote. Quote, significant pressure to cut costs resulted in Avanti's private equity owners firing, amongst others, engineers critical to maintaining ConnectSecure at a time of escalating cyber attacks, unquote. And for their part, Avanti, quote, rejects the notion that cost-cutting measures compromise the safety of its ConnectSecure products, as they provided a statement back to Bloomberg. It also said that, quote, the quality of ConnectSecure has improved under Avanti's ownership, unquote. The article contains some new reporting as well on the extent and impact of some of the attacks, including one that Pulse's own data center, as well as victims that were compromised by its weaknesses, were previously unknown. The article details how Chinese hackers compromised the network of Pulse's own data center in California through one of Pulse's own VPNs. And, quote, Avanti ultimately determined that 119 organizations were compromised in similar fashion. There's also some really good detail about the financing challenges that are driving some of these decisions in terms of headcount and personnel, including recently the use of so-called distressed debt exchanges, quote, in which private equity owned firms conduct out-of-court debt restructuring with their lenders' permissions. This is becoming more common as the ZERP lending craze comes into more of an interest rates or interest coming due cycle now that rates have risen. The article cites a research paper that notes that, quote, more than half of firms that used the exchanges between 2009 and 2022 defaulted on their debt again. So not exactly a strong track record. This article also came on the heels of a piece earlier in the week from the Financial Times entitled How Private Equity's Big Bet on Software Was Derailed by AI. The article lays out the fact that many private equity investors are worried that new capabilities, particularly those launched by Anthropic's Claude tool, could undercut the moats of their software investments. I think that's important because what they say in the article is, quote, takeovers of software companies by private equity funds accounted for about 40% of trillions of dollars in deal activity over the past decade. And they also say that such deals, private equity into software, represent 1/3 of the lending in the fast-growing private credit industry. So now that we find ourselves in an environment where it's more expensive to borrow, this eroding moat and by extension revenue stream can create the exact situation that is facing Avanti as their customers are walking away from the product in search of alternatives that are thought of or that actually are more secure. This might be why Morning Brew led their headline over the weekend with an article or a post called Is Private Equity Past Its Prime? Maybe, but as we'll see in the fundraising portion of this show momentarily, investors continue to pour money into the asset class more broadly. So I don't know if this is smart timing, buying the dips, or the sunk cost fallacy at work, but we're going to have to pay attention. Also, last week, Anthropic's Claude released a tool called Claude Code Security that promises to, quote, make frontier cybersecurity capabilities available to defenders, end quote. This is really kind of a bit of an ironic twist in terms of timing. This sort of code review and human-style analysis is exactly what PulseSecure probably needed back in 2020, 2021, 2022 as it was facing real challenges. The former CISO at that time of Pulse noted that he felt the product was so far gone that they either needed to scrap it entirely or completely rewrite the code, something that now would be possible without the headcount with tools like Claude Code and others. But regardless, I think there's a clear challenge here that involves not only the threats, but also the incentives at play, including the transactions behind it and those macro trends spanning both the geopolitical and AI arenas, each of which is a perpetually thorny space to navigate. It's hard to draw a fulsome conclusion from a single article, but I think it should serve as a cautionary tale, if not for all PE investments, at least for those that are cybersecurity products or services. You can cut costs, but cut security capabilities at your own risk. From a fundraising perspective, as noted, we've seen the exact opposite of what you'd expect given our previous discussion, with more than $40 billion in newly committed capital over the past week, including Thrive Capital raising not only $1 billion for its early stage strategy, but $9 additional billion for a total of $10 billion for their growth stage deals. Veritas Capital putting up $15.3 billion for their 9th PE fund and related vehicles. Battery Ventures posting $3.25 billion up to their 15th flagship fund. JLL Partners putting their 9th fund together at $1.4 billion, targeting middle market investments. And HGGC, which is co-founded by Hall of Fame quarterback Steve Young, putting up $3.2 billion for their 5th fund. So I can't square this circle for you between the articles and the fundraising, but it does remain a fun game to watch and a fun game to be a part of. And if there's anything I learned in the last week, it's that the fun games are worth it. A reminder, you can find links to all the articles that we covered in the comment section below, back issues and written transcripts at intentionalcyber.com, and we will see you next week for another edition of the Intentional Brief.